Finance with Excel Modeling, copyright Lou Gaddis. Topic 8, Financial Risk Management. In this topic, we're going to understand the IMM, Identify, Measure, Mitigate Risk Management process. And then we're going to measure risk using base case, which is a best guess point estimate, worst case, best case, hypothetical stress tests, scenarios, break-even analysis, and data tables. So the inspiration behind our exercise today is the Discovery Channel Gold Rush. Gold Rush is a show that tracks its star and lead, Todd Hoffman, as he tries to find gold in the Klondike. And what I have here is a model inspired by the show of their estimated season 2 free cash flows. And based on the show, I'm going to estimate that we have labor of $200,000, equipment rental of $88,000. There's about 150 possible days in which you could mine in Klondike, and that is when the ground has been thawed. About 75% of the time they mine, so there could be delays related to weather or delays related to equipment breaking down. So if I take my percentage of days mined over my season, I'm going to predict that they have 113 days of mining. I'm going to assume they can get 12 tons of pay dirt, which is the dirt that has the gold, into the wash plant. Now, a wash plant is a plant or a piece of equipment, kind of the size of, say, a large truck. And what you do is you put the dirt in the wash plant. It kind of power washes it with high pressure water and some vibration and a conveyor belt system, and the gold will fall down because it's a heavier metal. So they'll get about 1,350 tons of pay dirt to the wash plant. They'll average 0.25 ounces of gold per ton of pay dirt, which means they'll get 338 ounces of gold in season 2. Their major other expenses are diesel fuel. We'll estimate they have 200 gallons of diesel fuel per day, and that runs their pieces of equipment. One is the wash plant. That is that plant or that piece of equipment that takes the dirt and finds the gold. And they also need several trucks or excavators and dump trucks and things like that. And what they need to do is basically remove the topsoil and then get down to the dirt that's sitting on the bedrock, which can be, say, a few feet to maybe 10 feet below the topsoil. And they get access to that dirt sitting on top of the bedrock. And that's the dirt in which they try to find the gold. And the gold sits low on that bedrock because of it, again, it is a heavy metal. So they're going to need about 200 gallons of fuel. At $4.05 was the price of the price of fuel at the beginning of the year. Let's just assume it goes up by 2%. That's my fuel appreciation. And a tax rate of 30%. And gold, at the beginning of the year, the gold is $1,600 an ounce. What's forecasted goes to 2% increase. That gives me price of gold of $1,632. Now I can do my income statement of free cash flows. That gives me revenues of 338 ounces of gold times $1,600 an ounce. That gives me my $550,000. There's the we're going to assume they do an operating lease on their equipment. Again, those are the several trucks in the wash plant. They're going to have operating expenses of labor and another operating expense of fuel. And that fuel is those number of gallons per day times the number of days. That will give them an EBITDA of $169,853. There's no depreciation since they're doing an operating lease. That'll give them an EBIT of $169,000. Taxes of $50,000, and that'll give them an earnings or a NOPAT, net operating profit after tax, or a EBIT after tax of $118,000. And we're going to assume there's no depreciation, no CapEx, and no working capital. So that is also their free cash flow. So in this case, that is their free cash flow. So the question is, should they go forward with season 2? Should Todd Hoffman take the crew back to the Klondike to look for gold? Now, to answer that question, what we want to probably have is more than just a single point estimate. So we call this a single point estimate. So it's maybe my best guess. However, to make that decision of whether or not Todd should go to Alaska and look for gold, we might want to do some sensitivity analysis or some risk analysis. So what are the risks of operating gold or running a gold mine in Klondike. So we're going to talk about the IMM risk management process. So IMM stands for Identify, Measure, Mitigate. So the first thing we'll do is we'll identify the factors that affect the viability of the enterprise. And so what Todd would probably think about is, some of the factors would be, say, a cold winter, a cold long winter. If that happened, the ground wouldn't fall enough for them to be able to dig. That could be a decline in the price of gold, an increase in the price of diesel. All right, so these are, say, the major factors. Also, based on the particular land they have, there could be a low amount of gold per ton of dirt. So they might just wind up with a piece of ground that doesn't have a lot of gold in it. So those are the, say, major factors that would affect the viability of Todd Hoffman's gold mine. So the next step, once you've identified what your exposure is, the next step is to measure. So how do these risks affect cash flows and profitability? So what we're going to do is not just a single point estimate. We're going to do worst case and best case. So that's an estimate of kind of a reasonable range of inputs. We'll do some hypothetical and historical scenarios. We'll do some factor sensitivities with data tables. We'll do some break-even analysis. All right, what we're not going to do in this topic, and we might cover in a future topic, is do some stochastic measures, such as a Monte Carlo simulation. And then we'll talk later about how we'd mitigate the risk once we measured them. Let's go ahead and measure these risks. And what I have here is the price of gold from 1969 to 2017. I got this data from the St. Louis Fed. And what you see is there's been quite a big run-up in gold. And the reason I gathered this data is I just want to see how volatile gold is. That's going to be one of our major risk factors. And I've also identified what's the worst year. So let's go take a look at the data. I'm going to go onto the gold, and let's take a look at the historical appreciations of gold. So from 1969 to 1970, so 1970 price minus 1969 price over 69 price, that was a 12% decrease in the price of gold. I'm going to copy that down. And now we see these are the last, from 1969 to 2017, the percent changes in gold. And I want to look at percent changes because when gold was selling for $40, a $5 change is pretty big. But when gold is selling for $1,600, that price is not that big. So what we can do is we can look for the worst case. I'm going to say equals min for the minimum. I'm going to go ahead and put in my array here of all the prices. And you can see the worst case was negative 25%. And we could find that outcome. And there it is there, 1981. I remember 1981. 1981 was a good year. 1981 was also a year in which Paul Volcker decided to raise interest rates. Paul Volcker, the Fed chairman, decides to raise interest rates to tame inflation. And what that did is it caused gold prices to collapse. That's this drop right here. And one reason why that would happen is gold has historically been an asset that people hold when they're worried about the economy, and they're particularly worried about inflation. If you're worried about inflation, the value of all your stocks and bonds and money's declining, gold has historically been a good hedge or store of value when inflation is kicking in. So when the Fed decided to raise interest rates, the fear of inflation fell. Also, when you raise interest rates, people decide that, wow, why would I hold gold that provides no interest? Maybe I'll move my money into some treasury bonds that offer some high interest rates. So both those factors led gold to plummet by 25% that year. So that could be our worst case. That gives us an idea of how volatile it could be. Let's go ahead and take a look at our risk report that we're going to create. Or actually, it's already created for you. And the risk report is going to look like this. Here is our base case we just walked through. However, to understand the range of possible outcomes so that Todd Hoffman can decide whether he wants to go to the Klondike, we're going to look at a worst case, a best case scenario, and then we're going to do a hypothetical and historical scenarios. But let's go ahead and look at the worst case. And we're going to go ahead and look at the model, and we'll look at some of the formulas. I'm going to go to risk measurements. And again, you can see, let me minimize this a little bit. And you can see here are my parameters. Those parameters drive my income statement and my free cash flows. So what have I done here? For my worst case and the best case, this would be based on, say, your years of working at the gold mine, or at least your years of watching Discovery Channel gold mines. And what you say is, well, some of the bad outcomes. What's the worst case? In this example, let's assume that labor is locked in and equipment lease is locked in. So what's the worst case after you've locked that in? Well, worst case is the season is much shorter. Maybe the ground is frozen too long. And maybe because of, say, equipment failures and other reasons, you even mine less days. So maybe you only wind up mining 78 days versus a base case of 113. And then what if you wind up getting, say, you're less efficient at getting dirt out of the ground. Your equipment's, again, not working quite as well as you'd hope. And your workers aren't working as fast as they should. So you wind up with only 780 tons of dirt that go to the wash plant. And what if you also wind up with a plot of land that doesn't have very much gold? Say there's only, say, 0.1 ounces of gold on that plot of ground versus an average of, say, 0.25. So you only wind up with 78 ounces of gold, a terrible year, versus 338. And also that year would say that the price of fuel appreciates 40%. So your major expense is going up. And another, to make things even worse, the price of gold falls. It's going to fall to 40%. So again, you're just specifying some bad outcomes. We can run those numbers through and you can see our revenues plummeting and our costs are going up. And what we see in this case is our free cash flows are way down, $211,000 negative. But then we can look at a best case. Best case is we have a short winter, a long summer, and we become much more efficient. We are able to mine 85% of the time, and we get lots more dirt, and the dirt we get is full with lots more gold, and the price of fuel falls, and the price of gold goes up 40%. And if you do that, maybe Todd is looking at bringing home $700,000 in earnings and in free cash flows. So a best case and a worst case, I would say the minimum you should be doing if you're looking at sensitivity analysis. And what you try to do is build in your knowledge of that industry to try to think about what could go bad and what could go really well. Another thing you can do is hypothetical scenarios. So one problem with the worst case and best case, it's probably too bad and probably too good. In other words, in the worst case, everything goes wrong. Right? It's a long winter and price of fuel is up and the price of gold is down and your workers are lazy. And the best case, everything goes right. The price of gold goes up and fuel goes down, and so it's a long summer and the workers are doing well. So it does kind of give you a range of the worst possible outcomes and the best possible outcomes, but the scenarios makes you think about the interaction of the terms. So in other words, let's take a look at, say, what if you think there's just going to be a global boom in the economy? All right, so as an economist, I think about, well, how's that going to affect what's going to happen? Well, it's going to have no effect, say, if it's just a global boom. Again, the economy's humming worldwide. It's probably going to have no effect on the factors like, like weather and your efficiency of your workers, or how much gold is in the ground. So I'm just going to specify if the economy's booming, what's probably going to happen is going to be more demand for fuel from, say, the emerging economies, and that's going to drive up the price of fuel. And the other major effect is probably going to devalue the price of gold. All right, gold is generally held when the economy is looking really poor and people are nervous. So that's probably a global boom is going to be bad for gold. And we can just work through that scenario, and we're down at $62,000. That's not very good. Let's look at a historical scenario. So a historical scenario says just go look back through time and find particularly bad years or good years. And so some bad years is 1981. 1981, gold prices were down 25% in that Volcker Fed tightening. And that same year, I looked it up, and diesel fuels were down 8%. So if those two things happen, what we do is we'd be sitting at down $22,000. So very low free cash flow. And we look at another bad scenario, a long winter. If there were a long winter, what we see is just have much less mining days. And you can see that our cash flows are a bit lower. So it's a good way of thinking about what are the possible ranges of outcomes. I know I expect, say, 118 here. And it could be maybe the worst case is 211. and the best case of $700,000, and these are some scenarios I should be worrying about. So this gives us a good idea of what the risks of mining using Todd Hoffman's model of his gold mine in the Klondike. The next thing I want to do is some factor sensitivities. All right, that one problem with just using scenarios, you don't really key on what are the key factors. So we'll look at some of the key factors, how they affect, say, revenues and EBITDA and free cash flows, and let's do some break-even analysis, like what price of gold makes the gold mine zero cash flows. So let's go ahead and do some of these. First thing I want to do, let's go do this two variable free cash flow sensitivity analysis. So we're going to see how changing in the amount of gold in the ground affects free cash flows, and how the gold price appreciation affects free cash flows. So I'm going to do a link right here to free cash flows. Then I'm going to highlight that, and I'm going to put in a data table. Data, what if, data table. I'm going to put in my row. My row is the amount, and this is based on the base case, the amount of gold in the ground. So that's that 0.25. And my column is gold appreciation. So whenever you do data tables, you have to make sure you pick the cells that drive your outcome that is listed or connected to my data table. So there's my exposure to gold prices and gold content. So the best scenario, there's lots of gold and gold prices are up in this scenario, or this data table. Now you can also do a single variable free cash flow analysis. What if you want to see just the effect of the price of gold on revenue, EBITDA, and free cash flow? Well, we can just do a link to revenue, 550 right there, and was that B25? I can do a link to EBITDA. And I can do a link to free cash flows. So what I'm going to do is I'm going to see how one variable affects three outcomes. So I'm going to highlight this table, data, what if, data table. For a single variable data table, all you need to figure out is whether it's a column or row. And it looks like we're going to vary gold appreciations, which are in a column. So I'm going to click here on column and then click on the gold appreciation. Let me find that cell, which is right here, and hit OK. And now you see a data table that shows how, as gold prices go up, your EBITDA, revenue, and free cash flows go up. Here's a little graph of just our free cash flows under all the scenarios. Here's my best case, worst case, base case, and my global boom and 1981 anti-inflationary Fed actions and the long winter. Now, the last thing I want to do is do break-even analysis. This is really important. What you want to do is you want to see how certain factors affect the bottom line. So what I can do is a break-even analysis. What amount of gold will ensure that I have zero free cash flows? Like, what's that critical value of the gold content? So I can do a data, what if, goal seek. I'm going to set free cash flows to 0 by changing the gold content. There's my 0.25. I'm going to hit OK. Hit OK, and it looks like at 0.17 ounces gives me free cash flows of 0. I'm going to change that back to 0.25 because that's my base case, but I'm going to type in that number, 0.17. That's my break-even gold content. Now, gold appreciation, we can do what appreciation of gold or depreciation of gold will make us unprofitable. So I can do a data, what if, goal seek, set my free cash flow to 0 by changing gold appreciation. It looks like gold, it falls by 29.45%. I have 0 free cash flows. I'm going to hit escape, and I'll just write that in there, 29.45%. And the last thing is, what appreciation of diesel will make my free cash flow 0? So data, what if, goal seek. I'm going to set my free cash flows to 0 by changing fuel appreciation. 188%. So it looks like we can handle some increases in fuel. So let's go 188%. So this gives us a good analysis of the risk of operating a gold mine in the Klondike. This is my single point estimate base case. Here's my worst and best case. These are some hypothetical and historical scenarios. This is how gold appreciation affects revenue, EBITDA, and free cash flows using a one variable data table. This is seeing how gold appreciation and gold content affects free cash flows. That's a two variable free cash flow statement or free cash flow data table. And here's some critical break-even values. If gold prices fall by 29% or fuel prices go up by 188%, or if I only have 0.17 ounces per ton of dirt in my gold. Right, so this is a good way of thinking about how to measure our exposures to risk, how to quantify them. So let's talk about some advantages and disadvantages of what we just did here. What we did is definitely better than a single point estimate, right? It's better than knowing my best estimate is 180 or 118. It gives me a range of possible outcomes, my worst and best case. It analyzes the impact of historical environments and events, because I looked at that 1981 Volcker tightening, and I looked at the effects of a cold winter or a long winter and so on. And the cold winter, by the way, was a hypothetical. The 1981 was a historical one. Now, some disadvantages of what we've done. Well, there's really no we never indicated the likeliness of the scenarios. Like, what's the probability of a long winter? What's the probability that the Fed raises interest rates by the much they did in 1981? So there's two ways to solve that problem. One, you could, in your worst case and best case scenarios, you could specify that it's, say, a 1 in 50 year worst and best case, right? Or maybe it's only a 1 in 20 year. So it's probably good practice to specify that it's a 1 in 50 year best case and a 1 in 50 year worst case, right? Because a 1 in 100 year worst case is going to be a lot worse than a 1 in 10 year. So that'd be a nice thing to add to this model. It's called a 1 in 50 year, or the 50 year worst case, or the 50 year best case. The other way to deal with this is to do stochastic analysis, and we might handle this in a future topic, where we look at, say, assume that, say, gold appreciations have a normal distribution. And if that's true, we can calculate the probability of any outcome. And also we can use a model that uses, say, normal distributions and simulate gold prices and fuel prices. All right, but that's not going to be on this topic. So let's go back to the risk management process, IMM. What we first did is we identified the factors that affected your enterprise, and we decided those are the weather, gold prices, fuel prices, and so on. The other big one was gold content, whether we have a good piece of ground. And then we measured how these risks affect cash flows. So now we know exactly how much money we will lose based on different appreciations of gold. We know exactly that if gold falls 29%, we're gonna lose money, or greater than or larger than a 29% devaluation of gold. We know we need at least 0.17 ounces of gold in the ground. So that's the IM, the first I and the first M there. Now let's talk about the mitigation. When we talk about mitigation, I really consider there's 4 things you can do about risks. After you identified and measured them, what can you do? The first one is just accept it. I see the risks, I understand the losses. Either the losses are immaterial or just too costly, or I just don't care. But at least I've made a decision. I know what the risks are, I will accept them. The second thing you can do is just lay off the risks. In other words, just cease operations, right? I'm just not going to do this trek up to the Klondike because the risks are too great relative to the expected return. And the other thing you can do is maybe just delay operations. Maybe we have a plan, but we're not going to execute it until we verify it's not going to be a cold winter. We're not going to head out to the Klondike in May or June until we've verified that the gold prices are above, say, $1,500 an ounce or whatever your critical value is. Another thing you can do is hedge the risk. You can hedge the risk by maybe using insurance contracts or financial instruments or business solutions. Some examples are this. Maybe if you're worried about equipment breaking down, just get insurance on your equipment or get maintenance contracts on your equipment. Another way to do, and it's actually what Todd Hoffman does, if you watch the series, eventually he does this because he gets smarter, is you do core samples. All right, so you basically have this grid of this is the area that we're going to have the possibility to mine. So what we'll do is we'll take a sample of the soil in each one of these areas, and we'll get an indication of how many are, say, greater than, say, 0.2 or 0.25 ounces of gold in a ton of dirt by using you drill down and take a sample of the dirt, and maybe you say we're not going to go these particular spots, so we're going to focus on these, and these are the ones we know have greater than 0.25 or our critical value 0.17 ounces of gold. So core samples is a way of mitigating your risk that the content of gold is low. And that's going to have a cost. It's going to cost you a little bit of effort to do a core sample. You're not going to be drilling, but it's at least to get you to avoid the areas that have low gold content. And then another thing we can do is do derivative contracts. You can have contracts that guarantee the price of gold. You can go to a bank or another financial or any kind of financial institution, or maybe go to an exchange, like a mercantile exchange, and you can get contracts to guarantee the price of gold in 1 year. I guess one thing I didn't mention here is something we call an inventory build. If they're worried about fuel prices, one thing to do is maybe buy all the fuel at the beginning of the season and put all the fuel in a tank, so you can build up your inventory of any of your commodities that you need to use later. And then lastly, any risks that are left over, you could just hold capital. And what that means is if you think there's a reasonable chance we're going to lose $50,000, what you can do is make sure you have that $50,000 sitting in a bank account. Very safe instruments. So if the bad thing happens, you have cash and you continue operations. So this is the risk management process, IMM. So in this topic, we wanted to understand the risk management process, identify, measure, and mitigate. And we measured risk using base case, a best guess point estimate, worst case, best case, hypothetical stress tests, scenarios, and break-even analysis and data tables.